Stop scrolling. Look at your bank balance for a second. If that money is sitting in a commercial bank, you are not a spectator. You're standing inside the machinery that decides who gets sacrificed first when things go wrong. It is Monday, January 12th, 2026. Gold is at record highs. Silver has just had one of its fastest moves in years. Global markets are flashing stress. And while all of that is playing out on your screen, a new resolution rule quietly kicks in off screen. The laws written after the last crisis, the ones sold as protecting taxpayers, now point straight at large depositors and unsecured creditors. Before the state spends a cent, the playbook now says the system can reach into big accounts and use them as fuel to plug the hole in a failing bank. This is not a movie plot. This is your position in the hierarchy. It is why, after today, your bank account sits closer to the crime scene than to the safe zone. In the next few minutes, we are going to connect three moving parts: a broken precious metals market, a mountain of government debt, and the new rules for dealing with failing banks. Together, they explain how your savings can be drawn into someone else's rescue without anyone ever using the word default, and how low returns on savings fit into the same long, slow transfer of wealth. To see how we arrived at that new rule, we need to go back to the last crisis. For decades, the logic was simple. Banks took risks, and if they blew themselves up, the government stepped in with taxpayer money. That was the 2008 playbook: huge public bailouts, angry headlines, and an unspoken promise to depositors that they were safe no matter what. After that crisis, regulators in the United States and Europe said never again, and rewrote the system so losses had to be absorbed inside the banks first. In practice, that means there is a line of people ahead of the taxpayer. Shareholders are wiped out, then certain loss-absorbing bonds and other creditors, and if the hole is still there, large uninsured deposits can be written down or turned into shares in the wounded bank, while insured deposits are supposed to stay untouched. That step, when deposits are cut or converted to plug the gap, is what people mean when they talk about a bail-in. To see what this looks like in real life, picture a very simple balance sheet. On one side sit loans, securities, and cash at the central bank. On the other side sit the people and promises that funded it all. Owners at the top, various creditors in the middle, and deposits at the bottom. When losses punch a hole on the asset side, the resolution team does not send the bill straight to the taxpayer. They walk down that funding stack. Equity goes first. Then targeted bonds are cut back or converted. If the gap is still too big, they are allowed to start cutting into large deposits, turning what felt like cash in the bank into forced ownership of a failing institution. A handy way to picture it is as a Jenga tower. Under stress, the officials start pulling blocks from the top, first equity, then certain bonds. If the gap is large enough, they start chipping into the layer made of big deposits, while the insured layer at the bottom is meant to stay in place. On paper, that sounds tidy and fair. In practice, it means that when a major bank is in trouble, your account can be treated as part of the repair kit. This is not theory. In 2013, Cyprus was the test case. Two of its biggest banks were effectively insolvent. Instead of the old-style bailout, the doors were shut for days, and capital controls pinned money inside the country. At Bank of Cyprus, deposits above 100,000 euros were hit with a brutal conversion. Almost half of that excess was seized and turned into bank shares. Overnight, thousands of businesses and foreign clients discovered they were not just customers, they were loss-absorbing capital. A few years earlier, when IndyMac collapsed in California, insured deposits were made whole, but people with larger balances only recovered around half of what they had above the limit. Different country, different decade, same lesson. When the system is under strain, big depositors are not sacred, they are part of the design. Most of the time, these rules feel abstract. They live in thick policy binders and legal PDFs, not in your daily life. They only become real when the financial plumbing starts to shake, and that is exactly what is happening in early 2026. So-called safe haven metals are exploding higher. Silver has surged into the 80s per ounce and keeps grinding upward. Gold has smashed through levels that once seemed unthinkable. Bond markets are quietly adding a premium for political risk around the central bank itself. All of that is telling you the same story in different languages. Trust in the current monetary order is slipping. When governments are buried in debt, when interest costs eat more and more tax revenue, and when higher rates risk breaking the banks, the losses do not vanish. They are pushed somewhere. In practice, they show up as inflation that runs ahead of your savings rate, as regulations that make it harder to move money out of the system, and as bail-in rules that treat large balances as part of the fix when a bank gets into trouble. That quiet shift did not lead the news this morning, but markets are already reacting. This is why we're talking about silver. Sometimes a single market screams what the whole system is trying to whisper. Silver is not just a shiny metal. It is both a traditional store of value and a critical industrial input used in solar panels, electronics, medical equipment, and now new battery designs. Over the past year, the quoted price has climbed from the 30s into the 80s per ounce, with sharp spikes as investors rush for safety, while bullion dealers around the world report tight supply and rising premiums on coins and bars. On your screen, silver looks like a simple ticker. Behind the screen, it is a web of futures. Contracts, options, exchange-traded funds, warehouse receipts, and over-the-counter deals. For years, that paper world has towered over the amount of metal that actually sits in vaulted storage. Analysts estimate that hundreds of ounces are promised on paper for every ounce that could be delivered from exchange-registered stock. In human terms, imagine a stadium with 300 investors all holding tickets that say they own the same single bar of silver in a vault. As long as almost nobody asks to see it, the system works. If enough people step forward and say they want the metal, not the cash, the illusion breaks. The things we see now in that market, odd price patterns, delivery scrambles, and persistent physical tightness, are its way of saying that promises have multiplied faster than metal. When that happens, in a relatively small market like silver, it is an early warning of what can happen in larger structures that most people assume they can always exit, including bank. Deposits. Silver also has a second pressure point. The world keeps finding new uses for it. Solar power already consumes huge amounts of silver every year, and industrial demand has pushed to record highs, with a large slice coming from photovoltaic panels. Modern electronics need tiny but irreplaceable amounts in almost every connection. On top of that, solid-state battery designs point to a future where a typical electric vehicle pack could use around a kilogram of silver. If only a fraction of the global fleet adopted that technology over the next decade, it would require tens of thousands of tons more metal, before counting what hospitals, data centers, and power grids already use. Then there's the quiet demand for militaries, missile guidance systems, advanced radar, secure communication links, and space hardware. Defense buyers are what economists call price insensitive. They do not walk away because the price doubled. They pay because national security is not optional. So you end up with a metal that embodies monetary history, is vital for green energy, is baked into high-end electronics, and is increasingly strategic for defense, yet its market structure still lets large financial players create paper claims at almost no cost. That gap between the atoms in a bar of silver and the digits on a trading screen is the same gap you live with as a bank customer. On your screen, your balance is just a number. In the real world, it is a claim on someone else's balance sheet, governed by rules you were never asked to approve. While all of this is going on in markets, something else is shifting quietly in the background. Who controls the hard collateral of the global system? The BRICS and BRICS Plus countries, Brazil, Russia, India, China, South Africa, and their new partners, now control a large share of global gold production and have been steadily adding to their reserves. They are also testing a new settlement unit, a gold-anchored digital trade currency for deals inside the bloc. Roughly 40% of its value is tied to physical gold, the rest to member currencies, a way to settle oil and metals without touching the usual dollar rails. That does not mean the dollar vanishes tomorrow. The United States currency is still the main reserve asset and the grease of global trade. But direction matters. Every cargo of energy or metal settled in local money or in a gold-linked unit is one less automatic bid for dollars. Over time, that weakens the plumbing that let America run very large deficits at relatively low cost. Put simply, the more the world spreads its reserves beyond the dollar, the more pressure builds on interest rates and inflation at home, and the more tempting it becomes for policymakers to lean on quiet tools like financial repression and negative real returns on savings. That polite language hides a simple reality. Savers are used to subsidize the system. Now, pull the threads together. You live in a world where public debt has ballooned, interest costs keep climbing, precious metals are flashing, distrust, new ways to settle trade are emerging, and the rulebook already allows failing banks to push part of their losses onto large depositors. The easiest way for governments and big institutions to get through this is not to declare a clear default or announce that savings will be cut tomorrow. It is to use a slower mix. Keep official rates below true inflation when they can, keep big pools of money such as pensions, insurance funds, and deposits largely inside the system through regulation, and when a crisis hits, use the bail-in tools to turn creditors and large depositors into unwilling shareholders. On paper, this is called orderly resolution. From the saver's point of view, it feels more like this: I did everything right, I trusted the system, and I still ended up paying for someone else's risk. That is why many observers talk about the present as a kind of soft default, not shouted from a podium, but carried out through the steady loss of purchasing power and the occasional use of bail-ins when something breaks. Every crisis quietly decides who will be the airbag and who will be the windshield. In this setup, the relative winners tend to be heavily indebted governments whose real debt burden shrinks as inflation outpaces interest, asset owners who borrowed and then watch their debts eroded while hard assets adjust, and large banks that have pre-arranged funding they can convert if needed. The losers are more familiar. Large depositors sitting above insurance limits in weaker institutions, pension funds and insurers pushed into so-called risk-free bonds that lock in negative real returns, and wage earners and small savers whose income never quite keeps up with the rising cost of living. Bail-ins and negative real rates work together. One can take a chunk in a crisis, the other takes a little bit every year, but both exist to protect the core of the system by passing more of the strain onto the people inside it. To make this less abstract, think of 3 people watching this. First, the small depositor under the insurance cap. On paper, you are protected in a classic bail-in. Your main risk is not a sudden cut in your balance. It is the slow bleed of prices rising faster than your insured savings. Second, the business owner who keeps operating cash well above the insurance line. Payroll, rent, and supplier money sitting in those accounts is treated as part of the loss-absorbing buffer if your bank ever goes into resolution. You may never have thought of your checking account as regulatory capital, but the rulebook does. Third, the retiree whose future depends on a bond-heavy pension fund. You may never see a statement that says, "We took 20% of your money." Instead, the fund is nudged into assets that can guarantee negative real returns for years, and you feel it as a quiet shrinking of what retirement actually buys. None of these cases involves a headline default, but all of them are ways the system repairs itself by drawing on the people who trusted it. Whenever trust in official promises weakens, behavior starts to change around the edges. People quietly keep older silver coins because they know they contain real metal. Some small businesses agree to take bullion or coins at a price they work out on the spot. Families move a slice of their savings into things that cannot be printed or frozen with a keystroke. You can already see hints of that today. In the United States, pre-1965, silver dimes, quarters, and half dollars trade above face value because of the metal inside them, and in some communities, people talk about what a silver dime or a silver ounce is worth in groceries, fuel, or rent. That does not mean the official currency disappears, but it does reveal a simple pattern. When confidence in rules drops, people fall back on things. Tangible assets they can hold, land, tools, food, and precious metals, become mental anchor points in a system that feels more abstract and fragile. None of this is a call to rush out and buy silver or gold tomorrow morning. Every choice about money depends on your own situation, your appetite for risk, and your time horizon. The point, from a long view of history, is that metals keep returning in the same role. They sit outside the banking system. They do not rely on someone else keeping a promise. They cannot be pulled into a bail-in with a button press. And for thousands of years, they have served as an emergency bridge when paper arrangements are being rewritten. That is why, if you watch what central banks and major blocks actually do, you see them adding physical gold in the background, even while they talk about new digital currencies. They hold the atoms while most people live in digits. So where does that leave you on this Monday in January 2026? You are in a world where bank rules already treat large deposits as potential loss-absorbing capital, where safe-looking assets have often paid less than inflation, and where new gold-linked trading systems are taking shape, and where the prices of monetary metals keep straining against the gap between paper claims and real supply. You cannot control any of that. You can control how you measure your own wealth. Do you count it only as numbers on a screen? Numbers that exist as a liability on someone else's balance sheet? Or do you choose to hold at least some of it in things that do not need permission to exist? That is the real question here. Not what silver will trade for next month, but who carries the risk when the system needs to heal itself. Nothing you have heard in this video is personal financial advice. My aim is to map the architecture around you, so you are not surprised by rules that were written without you at the table. If you want to follow how this slow motion reset develops, from bail-ins to reduced reliance on the dollar to the fight between paper markets and physical reality, subscribe, turn on notifications, and share this with someone who still thinks a bank account is a neutral storage box. Because in 2026, an account is not just a balance, it is one of the cushions that takes the impact when the system chooses who pays. And the sooner you see that, the more calmly you can decide what to do while you still have options. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.